Imagine walking into a quiet, century-old regional bank. You're probably expecting to see dusty ledgers, right?
Oh, yeah. Dusty ledgers, marble columns, executives having those really hushed conversations.
Exactly. Conversations about, like, conservative 30-year mortgages, but instead you find them locked in this high-stakes, multi-billion-dollar cage match with Elon Musk.
It is wild.
Yeah.
They are frantically rewriting their core software with AI.
Yeah, and executing one of the most aggressive business model pivots in modern finance. Welcome to another deep dive, by the way. Today, we are looking at the Q2 2026 earnings report and the conference call transcript from WaFd Bank.
Formerly Washington
Yeah.
Federal, yep. Released back in mid-April.
Right.
And we are looking at an institution that's effectively trying to swap out the engine of a commercial jet while flying at 30,000 feet.
Which is a terrifying thought, honestly.
Right. But the objective for you listening today is to really decode their strategy by looking at how this specific regional bank is navigating, well, an absolute ruthless economic landscape. You get a pure look at these massive tectonic shifts.
Shifts in commercial lending, tech disruption, and basically the battle for your deposits. This earnings report completely shatters the illusion that regional banking is boring.
It really does.
But to understand the drama, we have to start with the raw numbers. I mean, they came out swinging for the quarter ending March 31st, 2026. They beat Wall Street's expectations across the board.
They did. The underlying metrics show a highly profitable engine. I mean, they posted earnings per share of 82 cents.
Coasting right past the 74-cent consensus.
Yeah, and that translated to $61.9 million in net income to common shareholders on revenues of basically $197.38 million.
Which is huge. But the headline profit isn't even the most aggressive move they made.
Not at all. The management team deployed a massive amount of capital to buy back 2.7 million shares of their own stock, and that was in a single quarter.
Wait, 2.7 million? That's buying back 3.6% of your entire outstanding shares in just 3 months? That is
Yeah.
a massive flex.
It really is.
It tells me they think the broader market is completely mispricing them.
Oh, absolutely. They bought those shares at a weighted average price of $31.85, which is roughly 1.05 times their tangible book value.
Okay, let's translate that metric for a second because it tells a really fascinating psychological story. Tangible book value is basically the fire sale price of the bank, right?
Yeah, exactly.
It's what you'd have left if you liquidated the buildings, sold all the loans, and paid off the depositors tomorrow. So trading right around that number is like, well, seeing your own company stock on the clearance rack.
That's a great way to put it.
The market is essentially saying, you know, we'll pay for the raw materials, but we give zero value to your brand, your future growth, or your strategy. So WaFd saw those clearance tags and just decided to buy the whole rack.
Well, the market thinks the clothes on that rack are hopelessly out of style. I mean, historically, WaFd was a very traditional single-family mortgage lender.
Right.
And in an environment of wildly fluctuating interest rates, having a portfolio full of 30-year fixed-rate mortgages, that's a major liability. The market is basically punishing them for their past.
But WaFd's management is looking at their future.
Exactly. Specifically, a strategic pivot they call Build 2030. They are transitioning away from consumer mortgages to become this commercial business bank, really focused on small and medium-sized enterprises.
Which requires an unbelievable operational overhaul. You can't just, like, change the font on your marketing brochures and declare yourself a business bank.
No, you have to rewire the human capital.
Yeah. And they highlighted a statistic that shows the sheer scale of this. 99% of their branch managers have now cast a rigorous certification process in small business banking.
Think about the actual mechanics of that retraining. For years, these employees spent their days evaluating W-2 income, appraising suburban
It's
houses.
pretty standard stuff.
Right, but now they are being asked to analyze complex corporate cash flows, understand treasury management software, structure SBA loans.
Taking 208 branches and completely reprogramming the frontline staff's expertise is a monumental cultural shift.
It is. They're betting that a highly trained local manager can win a commercial account better than some centralized algorithm.
But, you know, a strategy on a whiteboard is beautiful. The ultimate test is execution. So are businesses actually borrowing from them?
Looking at the numbers, they are?
Yeah, but the specific areas where they are refusing to lend are even more revealing to me.
Well, the loan portfolio saw an impressive 12% increase compared to just 3 months ago. That was fueled by $1.5 billion in new originations.
Wow.
Yeah, and commercial and industrial loans, or C&I, they drove 37% of that growth.
Mm.
Construction loans drove another 35%. So they are clearly hitting those Build 2030 targets.
Yet during the earnings call, CEO Brent Beardall deliberately pointed out this massive glowing blank spot in their portfolio. He specifically mentioned NDFI loans.
Right, non-depository financial institutions.
Exactly. And WaFd's exposure there is just $35 million. Out of a multi-billion-dollar portfolio, that is literally a rounding error.
It really is. And just to clarify, NDFIs are essentially shadow banks. We're talking private credit funds, fintech lenders, entities that don't actually take customer deposits like a traditional bank.
So they borrow massive amounts of money from places like WaFd, and then they lend that money out to consumers or risky businesses.
Exactly.
But wait, over the last 2 years, regional banks were tripping over themselves to lend to NDFIs? It was touted as the ultimate life raft, wasn't it?
Oh, yeah. Everyone was terrified of a collapse in commercial real estate, so banks used NDFI loans to basically diversify their risks.
So didn't WaFd essentially miss out on a gold rush by sitting on the sidelines?
WAF's leadership views that gold rush as a systemic trap. When you lend to an NDFI, you introduce middleman risk.
Right.
You are handing over your balance sheet to a third party who is almost certainly lending that money at much looser credit standards than you would ever accept yourself.
It's basically the equivalent of lending your pristine sports car to a friend, only to find out they're renting it out to strangers on the internet to enter demolition derbies. You have zero control over the actual driver.
That is exactly it. WAFT actually prefers concentration over blind diversification,
Meaning?
meaning they are perfectly comfortable having a heavy concentration in commercial real estate, provided they underwrite it themselves.
Oh, I see. They want to see the physical collateral.
Right. They want to stress test the cash flow projections, demand heavy upfront equity, look the project developer in the eye. They believe tangible assets vetted by their own certified branch managers are vastly safer than complex financial engineering orchestrated by a middleman.
That discipline sounds great, but we can't ignore the muddy waters of the 2026 economy. Even with pristine underwriting, elevated interest rates and global instability are just crushing commercial borrowers.
Yeah, and the transcript doesn't hide those scars. Their overall non-performing assets dropped to a very healthy 0.48%, but the chief credit officer highlighted a $51 million commercial relationship that is now over 90 days past due.
Yeah, a $51 million headache is significant for a regional bank.
Definitely. Now, they haven't charged it off, meaning they haven't accepted it as a total loss.
So they're working with them.
Right. They are actively working with the borrower to restructure or resolve the debt. This usually involves granting forbearance or maybe requiring the sponsor to inject more of their own cash to avoid a fire sale of the asset.
But it serves as a stark reality check. The highest quality underwriting in the world can't entirely insulate a bank from a macroeconomic storm.
No, it can't.
Let's shift from the loans to the fuel that powers them, because to fund a $1.5 billion quarter in new commercial originations, you need deposits. You need a massive influx of cash.
And the current battlefield for deposits is arguably the most brutal environment in modern banking.
WaFd has drawn a very clear line in the sand, though. Their stated goal is to increase their non-interest-bearing deposits. Basically checking accounts where they pay the customer 0% to 20% of their total deposits by 2030.
And they're currently at, what, 12.2%?
Yep, 12.2. Achieving this is critical to expanding their net interest margin, which is the spread between what they earn on loans and what they pay for deposits. They want to push that margin from 2.81% up to 3.0%.
Finding individuals or businesses willing to park their money for 0% return takes a miracle right now.
Seriously.
You are competing against mega banks with implicit government bailouts, aggressive credit unions, agile fintechs. But the transcript introduced an absolute wild card that completely shifts the paradigm of this fight.
Yeah, the CEO openly addressed the looming launch of Elon Musk's X Money platform. Musk is heavily advertising a staggering 6% interest rate on FDIC-insured deposits.
6%, plus 3% cash back on debit card purchases.
I read those numbers and immediately thought of the Costco rotisserie chicken.
Oh, that's a perfect comparison.
Right, because Costco famously loses money on every $5 chicken they sell. It's a financial black hole. But they don't care, because the smell of that chicken gets you in the door and you end up buying a kayak and a $300 blender on the way to the register.
Exactly. Musk is using that exact loss leader strategy. A 6% yield is completely unsustainable in a normal banking model.
But this time, the store owner happens to be the richest man on earth. He can subsidize billions in losses indefinitely just to buy market share and condition consumer behavior.
And the WaFd management team recognizes the existential nature of that threat. The CEO called X Money a potential Tesla moment for traditional banking, acknowledging it could permanently alter consumer expectations.
So how on earth does a regional bank in Seattle survive that? I mean, they can't match a 6% loss leader. They'd burn through their capital in months and trigger a regulatory takeover.
No, they wouldn't last.
I just don't understand how they prevent a mass exodus of deposits to an app offering double the yield.
They survive by refusing to fight on price. WaFd's counteroffensive relies entirely on building structural moats through complex relationships.
Okay, unpack that.
Well, a flashy app offering 6% is great for parking spare cash. But an app cannot sit down with a business owner, analyze their supply chain constraints, structure an equipment financing line, and simultaneously help them set up a trust to pass the company to their children.
Which explains their recent aggressive push into wealth management.
Exactly. They launched their wealth management division last August, and the execution metrics are striking. By the end of this quarter, they had already amassed nearly $450 million in assets under management.
And they're targeting $1 billion in their first 2 years, right?
Right. This is the ultimate deposit defense. When a bank manages your company's payroll, holds your commercial real estate loans, and manages your personal retirement portfolio, the switching costs become astronomically high.
Oh, I see. You aren't going to sever a deeply integrated, multi-generational financial partnership just to chase a promotional 6% yield on a tech platform.
Exactly. It's too much friction.
That makes sense for the complex commercial clients, but relationship banking only works if the basic plumbing doesn't frustrate the client.
Fair point.
You can have the most brilliant wealth manager in the world, but if a customer tries to transfer funds on their phone and the app takes 30 seconds to load, they will leave out of sheer annoyance. In 2026, technology is table stakes.
It is. But the tech strategy here deviates sharply from the standard regional bank playbook.
How so?
Most banks of WaFd size simply lease off-the-shelf software from massive third-party vendors. It guarantees a baseline level of functionality, sure, but it also guarantees you will look and function exactly like every other mid-tier bank in the country.
And you get locked into a vendor's slow upgrade cycle.
Precisely. WaFd bypassed this by establishing their own internal technology subsidiary called Pike Street Labs.
But wait, bringing development entirely in-house is a massive expense. How are they justifying the overhead?
By aggressively deploying artificial intelligence to multiply their internal output. They are using AI coding assistants to effectively double the speed of their human software developers.
Double the speed. That's insane.
And this velocity allows them to rapidly iterate on their own proprietary mobile app. They claim it has already cut load times by more than half. They are also building an AI-driven call center agent designed to provide instant 247 resolution for routine issues without hold times.
That sounds great, but the CEO was very careful to add a caveat to that AI rollout during the call. He insisted they are rigorously maintaining a live banker option.
Yes, the everyone deserves a banker philosophy.
Right. They're using AI not to replace the human element, but to automate the friction so human bankers can spend their time on those complex, sticky commercial relationships we just talked about.
Exactly. Now, we've covered the business pivot, the deposit wars, and the AI integration, but the most lucrative moment in this entire earnings report actually stems from a proposed change in a highly obscure federal regulation.
Regarding the most boring asset on their books,
Yes.
the $400 million plot twist, let's dig into the Federal Reserve's proposed rule changes regarding risk-weighted assets, because this feels like a massive validation of WaFd's stubbornness.
To contextualize this, regulators force banks to hold a certain percentage of their capital in reserve. You can't lend out every single dollar.
Right, you need a buffer in case loans default.
Right. But the regulators recognize that a loan to a pre-revenue tech startup carries a different risk profile than a mortgage on a house where the buyer put down 50% cash. So they assign different risk weights to different assets.
And historically, a standard single-family residential mortgage carried a 50% risk weighting.
Right.
Meaning, when calculating their mandatory reserves, the bank had to treat half the value of that loan as being at risk of loss.
Yes, but the Federal Reserve recently proposed a sweeping change, heavily driven by empirical data from the last decade. They realized that applying a blanket 50% risk weight to all mortgages, regardless of the borrower's equity, is fundamentally flawed.
So what's the new rule?
The new proposal drops the risk weighting from 50% down to 25%, specifically for single-family loans that have a loan-to-value ratio below 60%.
Meaning the loan amount is less than 60% of the home's total appraised value.
Exactly. And remember, the market punishing WaFd for its history as a traditional mortgage lender.
Oh, right.
It turns out, during that era, WaFd was underwriting with extreme conservatism. They're sitting on a $7.5 billion portfolio of single-family loans.
And what's the average loan-to-value ratio?
Across that entire $7.5 billion, it is less than 40%.
Less than 40%. A 40% average LTV is practically bulletproof. I mean, the national real estate market would have to collapse by more than 60% for the bank to start taking meaningful losses on the principal.
Exactly. WaFd has been screaming from the rooftops for years that this portfolio is essentially risk-free. But until now, the regulators forced them to hold capital against it as if it had a 50% risk weight.
So if this Fed proposal becomes a final rule, the regulatory math drastically shifts in WaFd's favor. What are the mechanical implications of that shift? I mean, they don't just get a $400 million cash deposit from the government, right?
No cash changes hands. But by cutting the required risk weight in half on a $7.5 billion portfolio, the denominator in their regulatory capital ratio shrinks dramatically.
Okay, so the amount of cash they are legally mandated to keep locked in the vault plummets.
Yes. Management estimates this accounting change effectively unlocks roughly $400 million in excess capital capacity.
That is a staggering amount of dry powder to suddenly have at your disposal without having to issue new stock or sell off assets.
It is a CEO's dream. The optionality it provides is incredible. During the call, management laid out a clear hierarchy for deploying that windfall.
Where does it go first?
First priority is to pour it directly into funding new commercial loan growth, accelerating that Build 2030 plan.
Makes sense.
If the lending environment cools, their second option is to return it to shareholders via more aggressive stock buybacks, taking advantage of that clearance rack pricing we talked about.
And third?
Finally, it gives them the financial armor to pursue strategic mergers and acquisitions.
It really is the ultimate vindication for being boring. Over the last few years, the trendy banks that chased yield through crypto deposits and NDFI middlemen ended up in crisis or, regulatory receivership.
Yeah, we saw a lot of that.
Meanwhile, the bank that stubbornly wrote hyper-conservative residential mortgages is on the verge of unlocking nearly $500 million in pure growth capacity.
It highlights the danger of evaluating a bank solely on its current quarter's top-line revenue. The structural discipline baked into a balance sheet over a decade is what actually determines survivability when the economic tides turn.
Let's bring all these threads together. Because WaFd serves as a masterclass in corporate adaptation. They are successfully dragging a legacy mortgage business into the commercial lending space.
Yeah.
They are completely ignoring the siren song of shadow banking risk. They are building proprietary AI tech to streamline operations, and they are leveraging a massive legacy portfolio to potentially fund their future.
All of which supports their central thesis, which is that in an increasingly volatile and digitized world, the human element is the ultimate premium product.
But that thesis raises a really fascinating dilemma for you to consider as we wrap up this deep dive. WaFd is betting its entire existence on the idea that complex businesses will always require a human relationship to navigate financial hurdles.
Right, no matter what yield Elon Musk offers on an app.
Exactly. But think about the trajectory of the very AI tools WaFd is deploying internally right now.
Yeah, if artificial intelligence continues to advance at its current exponential rate, we will eventually reach a point where an AI agent can analyze a company's supply chain, optimize its tax structure, and execute a commercial loan restructuring.
With the exact same nuance and creativity as a 20-year veteran branch manager.
Exactly.
When an app isn't just a place to park deposits, but becomes a hyper-personalized, flawlessly brilliant financial advisor available 24/7, does the relationship mode of the regional bank completely evaporate? Keep questioning the forces shaping the horizon, and we'll see you next time.